when it's recording. Hi everybody, welcome to Penny's Masterclass on insurance. I'm going to repeat a few things that I said. We're here to talk about all things insurance because it's open enrollment. We brought the experts. I will have them introduce themselves, but I just want to share a couple of the community comments on why people are here. Health insurance, dental insurance. Tomorrow's the last day of open enrollment. I want to make sure I selected important things while saving money. Amen. I'm Chrissy. I'm the founder and CEO of Penny Finance. I'm here for all things financial planning. Stuart from Marble and Sarah from Predictabill are the experts on all things insurance. We're so excited to have them. Stuart, you run a company called Marble. Can you just give the group a quick 1-minute background on you and how you got into the insurance space?
Yeah, I would love to. From birth, I entered this world, and I was like, I can't wait to work in insurance. No, I am great. I'm so happy to be here, and thank you to Penny for having me and hosting this. Very briefly, I have been in insurance now for the better part of 5-6 years. Though it really has been a lifetime. My parents met while both working in insurance in London many years ago. I built an insurance vertical within a mortgage company about 5 years ago called Better.com. I was launched and led Better Cover, which is their home insurance practice. So that's when I got licensed as a P&C agent. And then just sort of rounded out about a year and a half ago, I got licensed as a life insurance agent as well. And I'll talk about Marble more later, what we do, but I think it's safe to say I live, breathe, and spend a lot of time, maybe more than I'd even like, talking about insurance.
Thank you. Sarah, Predictabill, focus on health insurance. Can you tell us a little bit about you and your background?
Sure. Sarah Michaelchuk, founder and CEO of Predictabill. And before I built this, I spent 8 years as an investment banker, helping insurance companies raise money and merge with each other. But I found that I was actually pretty unhappy and confused with my health insurance options, even working at a big investment bank. And like Stuart, I'm also a licensed insurance agent in health as well as life. Basically what Predictabill does during open enrollment is we can crunch the numbers if you gather your documents. And I'll turn it back over to you.
Fabulous. Thank you both for joining us. For folks on the phone, the reason this group is together, the three of us are here, is because collectively across our three companies, there's one thing in common. We all want to make financial planning and insurance affordable. At Penny, we're financial planning. At Marble, shopping for all things insurance, from car insurance to home insurance. And Predictabill, deciding between health insurance. So we want to save you money. That's our goal today. But to do that, we need to educate you on all things insurance. So let's dive in. We always start with a quote at Penny. 15% is the average amount your budget goes to insurance and insurance-related products. That's a lot. So that's why we're here, and the goal is to focus on how we can reduce that. Or maybe it's okay. You need to protect your wealth and make sure you feel good. So what's the agenda for today? We're going to talk about what and when do you need to start thinking about insurance, protecting your assets, protecting yourself, protecting your family, how to save money, retirement, tax credits, and what is truly necessary. So I'm just going to talk 2 seconds about your big financial picture. Then we're going to go to Stuart. He's going to hit on all things home, car, house, insurance, and then life insurance. And then we're going to go to Sarah. So the thing I want you all to take away from today is insurance is an active part of your financial picture. It shouldn't fall to the bottom of the list. And it is a part of your financial planning. It might not feel like it, right? It might feel like an expense. It might feel like, oh, something I just have to do. But it actually is a really, really important part of your financial plan for 4 reasons. Either protecting your health, protecting your income, protecting your assets, or anticipating the future. And the goal of insurance is not to just waste money throwing away money to premiums. The goal is to help you if you end up in a situation where you might have to put up a certain amount of money, it covers it. And so these are the various types of insurance that you might need: health, life, home, car, business, long-term care, disability. There's more, pet. But the goal of insurance is to anticipate a need that's greater than what you have the dollars to spend on. Let's start with protecting your assets. So this is the first bucket. There's health, which Sarah's going to talk about, but then there's your assets. So you own a house, you own a car, you're renting an apartment, or your own life is an asset, right? Stuart, let's turn it over to you for a second. Educate the group on what are the first things to think about with protecting these important things in your life.
Yeah, I think that, there's sort of like a social contracty piece to insurance, all forms of insurance, right? But I live and breathe really in the P&C, property and casualty. So the stuff you have, add the life and some health, but really life. And I think when you sit down and you look at your financial picture, a big piece of it is mapping out what has value to you. Items, things. We talk about this a lot at Marble, like making it easy to protect everything you love. Because while insurance is boring, right? Like, I'm not here to say it's not. The stuff that it protects is not boring to you because it's probably the most precious thing to you. So, what I would say is like, look at the assets of your life, your technology, where you live, your pets. If you're married, if you are buying a home, if you have a family coming together. These are things that there are probably financial instruments, because that's what insurance is, to protect. And then you start to do the sort of more tricky work of thinking, how much do you want to protect it, and to what extent, and then who do you want to trust to protect it, what brands, and how do you evaluate those brands?
And what happens if you just don't get insurance? Is that allowed?
That is largely allowed. There's one exception. I won't kick down your door or anything. There are two main blocks where you really have to have it. If you have a mortgage, mortgage companies are going to require it. I guess as a sub bullet of that, many landlords require it too. And then in most states, I think in every state except for like 2, you are legally required to drive with insurance. So those are really the ones that are like mandated. Otherwise, if you don't take insurance, some people even call that like kind of like colloquial, like self-insuring. You're like, like I'm just gonna like pay out of pocket for whatever the heck happens, and like, look, it's just a math problem, right? Like, these things, again, it can feel emotional because I have an anecdote where, at the peak of COVID, my wife and I, before we had a kid, we bought a cat who I became codependent on. And we had pet insurance for him, and then he got sick, and he's fine now. So no, there's no cliffhanger here. He's great. He's still the light of my life, in addition to my daughter. But we took him to the vet, and like at the height of COVID, like he couldn't go into the vet, and so we dropped him off, and they called, and they're like, "This is what's going to cost." And suddenly, that sort of like conceptual, insurance debacle, but buying Healthy Paws insurance and convincing my wife we needed it became very real, because it was like, $1,000 or something for a night, because they knew they had me on the hook, and insurance covered all of it. So the math becomes real very fast, because like it's not like I had $1,000 sitting around to like provide IV fluid to my ragdoll cat.
Right. Okay, tell us how to think about coverage and think about premiums, particularly when it comes to home, renters, and auto, which, like you said, these are generally required, generally across all states in the United States, a must-have. How should people think about their coverage and their premiums?
Yeah, I mean, these are like, I would really encourage people to look at these sort of like headlines and like kind of interrogate them as like things that one actually should do, not just like platitudes. You could go to Bankrate or whatever and like probably see similar themes. I think a key part, and I think what Penny excels at, and what sessions like this are great at, is like putting them into practice. Like what are the sub bullets behind each of these? So like, shopping around is a chore. It's a chore that you probably don't want to do. I mean, there's a lot of chores that one doesn't want to do, but shopping around is truly the best way to get a better price, because not every aggregator has access to every carrier. There are marketplaces on top of marketplaces on top of marketplaces, and finding that carrier that wants Chrissy's risk versus the insurance carrier that wants Stuart's risk, is a chore, and it's something that you will benefit from doing. So set aside some time to do it and like get your stuff ready. I mean, again, plug for Marble, we do a lot of that on autopilot. So that's kind of why we built Marble, but it is a chore and it's something that does take time to do. You can toggle your deductibles. Again, this, Chrissy, to your question before, this gets into a little bit of that piece of like, not having insurance, right? If you bump that deductible up, and this comes up in health insurance, you're going to see more out-of-pocket costs, but it can't really bring your price down. I was just working on a customer with this recently. And then like bundling, like it's not just home and auto. You could typically bundle a renter's policy in, you can bundle recreational vehicles in. So if you're either like talking to an agent or if you're doing it online, like, push the counterparty that's trying to win your business to say like, how can I bundle? Because I think people like, watch TV and whatever and hear like home and auto, home and auto, home and auto. Like I don't own a home. So like, I'm like, well, I guess I can't bundle. It's like, no, I mean, I bundle my renters and pet with Lemonade and get a 15% discount. Those are not conventional bundles. And Lemonade makes it easy because they're online, but like you should just ask because there's probably a discount for it.
Yeah. So a question that comes up a lot at Penny, because we're always trying to unlock dollars, is how often can you switch insurance? Like car insurance, is it every 6 months? And if you find a cheaper provider in the middle of a period where you already have coverage, can you cancel it and move to the new one? Like, how should people think about that?
I love this question. This is like one of my personal like missions, because like insurance is regulated state by state, and it is mandated for many insurance types, basically all property and casualty types, that you are refunded pro rata. So you are refunded what has not been utilized by the carrier. So if you paid 12 months and you cancel in 6 months, you get 6 months back. And it's a huge, this is something we deal with like multiple times a day at Marble, because people are like, oh, I love these savings you found me. I guess I'll buy it in 6 months. It's like, no, you could just get it now. A competent technology partner or agency should handle the cancellation automatically for you. We just have a little wizard that just sends a letter to your carrier. We set a reminder for when you should get that refund from them. And then you switch into that new policy, make sure the dates line up, and you lock in those savings and you get a refund. If it's your home insurance, they'll probably refund to your escrow account. These are all nitty-gritty things, but basically the headline to your answer, Chrissy, is if you find a better rate, you are not constrained at enjoying it and enjoying those savings.
So everybody,
and there's also
everybody can look up bundling right now and potentially.
Yes, and there's also very limited penalties. Like you typically don't do a hard credit check for many types of insurance, so you're not hitting your credit. It's typically a soft pull, or what they're using like an insurance score, which is not it's not a hard pull, so it's not really going to hit your credit. In most cases, some places do, or if you're non-standard, you might experience it. So non-standard means like maybe you have an accident history or something like that. And yeah, I guess I'll just wrap up this long spiel because I got excited about being like, that's again part of the reason we wanted to build Marble. We wanted to build like a Robin Hood for insurance, because it really is a financial asset that you should be able to swap in and out of based on your risk and the counterparty that you find. Progressive wants me one day, they might not want me next year, but that day they want me, I want to be with Progressive because I'm gonna get the best price.
Right. Thank you for that. And then my last question for you, and I don't want to go deep into deductibles because I know Sarah's going to cover this and really like dig deep for us on the health insurance side, which is like, you can translate it to home, renters, and auto. But this point of choosing deductibles wisely, I think is really critical. So I have car insurance. I backed the car into the garage last month.
Yeah.
I have a claim going on. I paid my $500 deductible. Insurance is paying the rest. But now I'm like, oh, shoot. Like, is my insurance premium going to go through the roof?
Yes. No, this is.
How should people think about deductibles and like sort of the like just maneuvering between these policies to make sure your premiums aren't through the roof?
No, again, this is like where we can pick up where Penny really puts you in terms of like your spending, what you have available in terms of cash or household budget, because I'll answer it slightly in form of like an anecdote. Like I was talking to another InsurTech founder, we all get around and swap war stories. And he was saying that basically what he does is he goes for like the highest deductible plans for his auto insurance, because he's really hesitant to ever make a claim, because exactly what you said, Chrissy, like, and again, we go through this like all the time. Like you get a great quote from someone for Progressive, you're working them through the quote, they're excited, they got savings, then you hit that button that says like pull reports, and it pulls their history, their accident history. And then like that price often, can go up quite a bit, can double or triple if there's a recent accident history. So it's hard to bracket real. It's fine. It'll come off soon. And you probably are a great driver and great credit and all those things. But it is something to be considered about, right? Like, and there's actually a name for it that I can't remember in the insurance industry, because like they hate that. They really want you to make every claim possible because they want to understand your real risk. Sarah, I'm sure, has dealt with this all the time. But like, you kind of, God, the name is eluding me now that I'm on the spot, having put myself on the spot. But basically there's this world where people kind of like bundle their unmade claims together, and they're like, oh, I dinged a windshield, all these things, and then you do it all at once. And the insurance carriers hate it. They don't hate it like it's illegal. They just hate it because it's like you getting a slight edge on them in the actuarial world. So I would say, think again, to make this actionable, get an estimate if you have a repair after a claim, things like that. And then I would map out, where that fits in your monthly, yearly, quarterly household budget, and think really hard about what that compounding cost impact could be if it impacts your auto insurance for the next 5-6 years, versus if you paid $300 to fix it right there out of
pocket. Let's go through a couple examples. We love examples at Penny. So these are common women. Life insurance. So we've talked about home, auto, renters, life insurance. 4 examples for you. First time home buyer. Does she need life insurance?
Life insurance is a really high correlator indicator of, or buying a home, of when people buy life insurance. When you buy a home, typically if you're financing it, or really anyways, you got taxes, you got maintenance, you got all this stuff. You are incurring a stream of liabilities. And that stream of liabilities, unfortunately, should the worst happen, will continue and will become a liability for your successor, be they a child, be they a spouse, be they your parents, be they your best friend who takes your house home. So life insurance is a very common, to the point that if you're buying a home, you've probably been hammered by life insurance agents who saw that you had a hard credit check and are now trying to knock down your front door. Way to protect that future liabilities. So it's a huge, it's like the Venn diagram on that one's almost a circle.
Okay. Mom of young kids.
As a parent of a young kid myself, I will say that maybe the second greatest liability you can do besides buying a home is having a kid. My wife and I just rang up all the groceries for our daughter before we rang up our dinner at Whole Foods, and I was like, "Oh, that's where that's going." So again, I think the math really kind of is a similar. It's a similar math problem. Future liabilities: education, childcare, college. You can structure life insurance to have a larger payout at the end if you wanted to help with things. Again, now these are not. There are upfront costs for these things, right? And we'll talk about it on the next slide. And they're monthly costs. You have to, again, structure that in a way that makes sense for you.
What if you don't have income? I always thought about you get life insurance, not just because of the liabilities, but to protect the stream of your income should you have
I mean, I think that there are different life insurance policies that can provide annuities that can provide continuous income streams. I think that is a moment where it starts to stray closer to financial planning. And life insurance, again, and this will come up on the next slide, life insurance in particular, some products, if in a different light, can look really a lot like they are financial planning products. So I would basically encourage you, if you are looking for that income protection, while a life insurance or annuity type product can be powerful, you may find a financial planner has a different perspective on how you can achieve that, either through index portfolios, dividend accounts, things like that.
So the way people should think about life insurance, at least for these first 2 examples, is the liabilities, the cost of the things that you value in your life, the cost of the home and the cost of the kids, not necessarily the income. What about someone retiring, now rolling over her 401k to an IRA, no longer making income? Life insurance needed.
This is where a lot of people reframe their life insurance, and maybe they have a term policy. So again, they had a policy that defined 10, 20, 30-year term. and maybe they forfeit that and they take the principal back because they're like, look, I have my career has ended. The big lump, my kids are older, maybe they are earning or whatever expenses. When you retire, typically your expenses step down, so you maybe don't need that flow of income anymore. So what you're really getting into that estate planning conversation. So what then people often think about is larger death benefit plans that have a more concrete benefit. Now, one call out I'll add here for people who are thinking about that is more and more we're seeing plans that also provide end of life care coverage, as well as like skilled nursing coverage. And that's something that I would really encourage people to look at, because as someone who is two aging grandparents who were fortunate to have great skilled nursing assistants, it is not a trivial expense, and it is not an expense that you can really forecast. You want them around as long as possible, and that candidly means that expense can recur. So I would investigate anyone going through that to look at that, not just the death benefit.
Right. Good point. And the last example is a newlywed. No house, no kids. You're just getting married. Do you need life insurance yet? Or no? You wait for the house, wait for the kids, wait for your liabilities, your expenses to increase.
This is a moment where, again, some of these scenarios are scenario led and insurance follows, and then insurance can kind of inform with financial planning. I would, if I were talking to newlyweds right now, what I would say is that the order of operations changes: life event, financial planning, then insurance. Whereas a lot of these are life event, insurance, and then financial planning. This is like, what are your goals? Are you going to travel for 6-7 years or before you have children, or do you own home? It's newlyweds are as diverse as the people that comprise the couples. So it's so hard to sort of paint with a broad brush. The advice I would give is make a financial plan together, and then if income protection is concerned for you, if you plan on imminently buying a home or starting a family, then those will trigger, you'll sort of fit into one of these other categories, and then you can make a plan.
Makes perfect sense. Okay, last question for you, and then we're going to talk about health insurance. Life insurance. We hear about it all the time. We get these robocalls all the time. People wanting to sell you insurance. You need insurance. You need life insurance. These are the 4 most common types. Take us through them really quickly. I want everyone to leave this session knowing the difference and knowing, and these are in order of cost too. Yes, I'm guessing.
Sort of.
Okay.
When we get to the universal stuff, that can really depend on where you are when you're getting the policy in terms of like age and stuff, but we'll talk about that when we get there. But term, that is, if I were to make a sort of non-financial advisor recommendation, I think most people, I think LearnVest pushed very hard back in the day for term, because whole life is a little bit trickier. So term is your typical, more like your 10, sometimes 5, 10, 30-year term policies. You're paying typically a fixed amount, and that policy has a start and end date, and there's a benefit at the end. That gives you a lot of benefits. You have a lot of flexibility, or more flexibility than you would in a whole life plan. You can let that plan mature and roll it into another plan. You can reevaluate, and you can avoid some of the more complex financial maneuvering that comes with whole life insurance. Whole life insurance is something that people are very eager to sell. When you get those robocalls, it is probably a whole life plan that is being sold to you. And that is a plan that's going to set you up with a fixed expense every month, a fixed cost, for probably some sort of range of returns or semi-fixed returns based on market performance. Now, a financial advisor reviewing a whole life proposal is going to come in and say that return, there's typically fees on that. Now, financial advisors have fees too, and the return may not match even what you get from an index fund. Additionally, it's not super easy to get out of a plan like that. Or if you do, there's additional cost to forfeit it or like somehow roll into something else. Universal and variable universal has it gives you more toggles, and it actually can index a little bit cheaper than whole life, because the returns aren't as guaranteed. If your universal plan if the market does badly or the basket of investments does badly, you might not get a great return on that year. Now the benefit again is that you can toggle it. You can put less in. You can adjust your premiums. So if you are, I would say maybe earlier in your career, your income is less stable or less forecastable, but you want that like kind of accruing protection. Universal is a really good thing to look at. And then variable universal is actually even a little bit more control, where you can even sort of direct your investments into specific tranches, or your premium into specific tranches. I believe the main difference with variable universal is I don't even think the principal is protected. I think that there's a chance that if it really underperforms, you can actually dig into the principal of the policy itself. So it's really kind of an investment product at that point. I mean, a lot of these are investment products, and you see a lot of life insurance agents who have to register as financial advisors as well.
Right. I want to ask the audience, anybody have life insurance, either provided through your company or purchased on your own? I want to see what people say in the chat. And then one of the questions we get all the time at Penny, Stuart, is can you sell your life insurance? Like, can you say you buy a term policy for 20 years and you're 5 years in and you're like, I don't want this anymore, it's too costly. Can you get rid of it?
You can, but it really depends on the policy. It's like it'd be called like a settlement. And there are like it depends on the term, the performance of the underlying portfolio, and I guess like how eager you are to sell. There are I mean you can, I guess is the answer. It's just like there's a lot of factors that go into it, and I would think very carefully about it.
Okay. So it looks like most people on the call have life insurance through their company. Anything that these folks need to think about? Potentially, do they have enough coverage, or just be, thank you, company, I'm all good, I can move on to the next thing?
Well, through the company, those plans are typically group plans, so they're usually priced at like on an aggregate basis, which means that they come with a lot more conditions as well. So I would strongly advise looking at first of all what the payout conditions for a group life plan are. Does it travel with you? Probably not. When you change jobs, does it what does it actually cover? And then how much does it really cover? Some of these plans are like $10,000, $20,000. They're not really substantial payouts. Okay. I myself, when I moved into this job, I went from not having life insurance to having life insurance, because there wasn't like on my own individual basis, because at that point, my wife and I just got married, we were thinking about having a kid, and there was also this sort of, frankly, I actually had to, because of the board, there was a sense that like the board needed protection of, if something happened to me, there would be a payout to the shareholders of the company. And that was not, nothing that was provided by our, JustWorks or our 401k provider was close to that level of payout. And I would encourage people to look at their own family household in the same way, right? Like, would it be enough? How many years, months would it get you or your loved ones?
Okay, so homework for everyone on the line. Look at your payout conditions, look at how much coverage. And then think back to what we discussed and like where you're at in your life and what you're trying to protect and who you're trying to solve for. Okay. Any other questions for Stuart on insurance? He will be here till the end, so we can talk questions at the end. If you have any questions, put them in the chat. We'll pull them in. Sarah, everyone wants to talk to you about health insurance and open enrollment.
Yeah, well,
first through this topic.
Yeah, so I saw a lot of people already chiming in. Obviously, if you have life insurance through your company, you probably also have your health insurance through your company. But I would love to see people chime in and just say, do you get an employer plan, or are you independent, Marketplace Obamacare? Would just love to see that. And while you guys are writing in, I will leapfrog on what Stuart was saying. Not only should you check the conditions of your life insurance payout through your work, But a lot of times there's a condition where when you quit your job, you have like 30 to 60 days where you can actually still opt in to continue that group policy, the group life policy. So check that as well while you're checking, especially if you're considering quitting to do, your side hustle full time or something. But with that, let's transition into the health insurance.
Yep. We're seeing a bunch of employers, Sarah, just so you
awesome.
know. Okay.
Awesome. Great. That was what I was expecting. So something that's different about health insurance versus P&C or life. When you buy your auto policy, you're not hoping to get into a car accident. When you buy your life insurance policy, you're not hoping to die. But when you buy health insurance, you kind of are hoping to use it. And so if you think about what is good and bad for insurance companies, the worst possible thing is if someone says, oh, I'm going to go buy my insurance because now I need to use it. So that's why open enrollment was invented, because the insurance companies, they know that you're going to use your health insurance. You're going to go to the doctor when you're sick, and they don't want you to sign up the week that you get sick. So they say, okay, we're going to make this short period in the year. Maybe it's just a week or two. And we're going to try to hope that nobody looks at this, because it's always true. Financial services companies, they make money when people aren't paying attention. Even if that's just like your high yield savings account and you could get a higher rate somewhere else. Anytime you're paying attention, you're going to get the edge. Kind of, I think Stuart used the phrase, the actuarial edge. So basically, if you know that you have certain things you always do every year, you can start planning ahead, you can model, and you can crunch those numbers. So maybe we could kind of move on to the next slide. So we'll start with the employer-sponsored options, which is group options. I think Stuart was mentioning the group life policy as well. And what that means is that everyone's aggregated together to buy insurance. And so there's two reasons that the employer-sponsored health insurance is typically so much better than Obamacare and the marketplace, which number one is just the law of large numbers. If the whole company is buying insurance for 3,000 people, that risk is spread over lots of people. So that first of all, they're going to get the lower rates. But then on top of that, most companies in the US cover 70 to 80% of your premiums. So, sometimes we'll get people where they say, I'm going to stick it to my employer and I'm going to show them I'm going to get my own insurance. And that really never makes sense, because you're going to be paying typically 5 times as much to be getting it independently. So it's usually a no-brainer. If you have an employer-sponsored option, you're going to do it. Now, if you're in a dual income household, things can get pretty interesting because coverage can be super different between different companies. So, if we want to hit the high level when, it can actually be completely random. We've seen HR people plan open enrollment around their wedding, so it doesn't bother them. So it's not every year that it happens at this exact date. Sometimes companies will say every year it's, the 1st through the 3rd October month, 3rd Wednesday of October, stuff like that. So check when your actual open enrollment period is. I saw someone in the chat commenting that their last day is tomorrow. So you might already be past it. The other interesting thing, though, just a tip with employer plans, if you realize you made a mistake, those deadlines can be a little bit squishy. So you can sometimes reach out to your HR person a day or two after and say, oh, I meant to do this. And they might be able to change it. They might not. It really depends on the company. But in order to think about this properly, you need to pull out your benefit guide. And I'm going to have some examples on the next slide. But this is just kind of similar to how, you need your W-2 to do your taxes. You can't make a decision without having all the numbers and doing the math. And you might need to ask for extra information. But again, the reason this could be worth it, especially in a dual income household, or sometimes even some companies, one plan will have fertility coverage and other options won't. And that can be $100,000 swing. It can have a huge impact. So it really is important. And I can pause for a second. I don't know if anyone has questions before we go to the next slide.
There was a question for Stuart, but we'll get to it at the end about life insurance. Someone's mind was brewing. So let's keep going.
Great. So, here's some of the examples. And I think Chrissy probably mentioned that you'll be able to access this later. So if it seems really text heavy, this is just a resource for you. But, the employer sponsored plans are better, but the downside is because they're better, they're all different. And the documents you're going to look at to find this information, they'll look totally different. So we can't tell you this is exactly what your document looks like. At the bottom, here's the Tesla benefit guide. It has a Tesla on the cover. A lot of times these are more marketing documents that are kind of pitching you on why you're working at a great company. And it's not necessarily an insurance document, or they're not showing you the insurance document. Here we have the JP Morgan one. Everyone's like super happy working in their corporate job on the cover. And so then, look for these documents. A lot of times when open enrollment starts, you're going to get a blast email from your HR team, and they're either going to attach the PDF. They might send you a link to a website. Those links, for example 1 and example 2, I believe, go to Morgan Stanley and Netflix. But remember, sometimes those websites, they're only going to work on your intranet. And so you're only going to be able to look at it on your work computer. You might want to download it so you can look at it on the weekend or whenever you're going to actually do this. And then another thing that's kind of tricky is sometimes they actually separate it out. So they'll give you one document. It has all your deductibles, copays, all the typical sort of insurance things you think of. And then there's a different document that's going to show you all these different words that mean premium. And so that's rates, contributions, paycheck deductions. It could mean a million different things, but if you have 3 different plan options, it's really unlikely that they all cost the same thing. So you need to make sure that you find in your document, where does it actually say what the difference is in these costs? Because sort of like Chrissy alluded to, you don't want to be spending so much extra on premiums. They're not all created equal, basically.
Right. So that what you just described is exactly what I'm going through right now with me and my husband's insurance. The premiums are on one beautiful, like 1-page doc, but then all the nitty gritty is on another page. And we're trying to figure out like which one is better, which one do our doctors take, which one has the fertility benefit, but I want to go for the cheaper one. What am I giving up if I go for the cheaper one? So excited to dig into this more with you.
Yeah. Great.
So let's go over some examples, just like we did with Stuart. We love doing this. So same women.
Yep.
Young, healthy, first-time home buyer. What should she be looking for in her health coverage and when selecting a plan right now during open enrollment?
Yeah. I mean, would you mind actually, if I jump to do this a little out of order, and I'm actually going to start with the person on the top right. Oh, sorry. No,
yeah. Top right. Poor health.
Poor health. So and when you say poor health, like what I'm going to assume there is that this is somebody with a chronic condition.
Yes.
I'll just give like ulcerative colitis and Crohn's as an example. What's interesting is actually if you have like poor health, you have a lot of extra info that the insurance company doesn't have. So you might actually know, okay, I go to my GI this many times a year. I always get a colonoscopy. You might actually have a list of things that you do every year. So this is one where it makes sense for you to actually be able to model that out and say, oh, okay, is there a plan that has like no deductible and just copays? And maybe that's great for me. Or modeling out those costs. But basically, this is like the classic situation of asymmetric information where you know more than the insurance company and you can like really game the system if you're this person. And now I'm going to kind of slide over to the left there and go back to that young and healthy couple. It's sort of irrelevant whether or not they've bought a home. So I'm going to look at the health fact. And what I'm going to highlight here is something that I've seen Chrissy talk about a lot, is oftentimes when you're young, and I know that a lot of you mentioned working for employers, it's not even necessarily a choice. You're kind of going to get shoved into a high deductible plan, or it's almost always going to be an option. And so one of the biggest mistakes people make is, and I've done both of these things. First of all, if you're on a high deductible plan, you're kind of getting all the negatives, but unless you're actually maxing out your contributions and investing them, you're not getting any of the positives. So when high deductible plans were invented, the idea is, okay, when you're 20, you're going to go on the high deductible plan and you're going to sock away all that money that you weren't spending on the high premiums. and you're going to invest it in the market, and it's going to grow tax-free, and then you can use that money later in your life, perhaps to pay for the long-term care, some of these other things. So basically what I would say, if you are young and healthy, if you've already determined that it makes sense for you to go on a high deductible plan, or if you're being forced into one, make sure that you're maxing out those contributions. And then make sure that once you max them out, you don't let them just sit there, you actually invest them. So that would be my tip for kind of the top left, the home buyer couple.
Okay. Quick question. Is a high deductible plan usually the lowest premium? Or no?
It is. I mean, well, so here's one of the funny things about employer coverage. There's no rules around it. So we've sometimes seen companies, insurance companies are particularly guilty of this with their own employees, where they'll kind of put tricks and they'll say, oh, this plan is more expensive for people that aren't paying attention. So like I've seen this there, there's a Midwest life insurance company that does this to their employees, where they're sort of like, this is the plan for if you didn't pay attention in open enrollment. But I think I know what you're getting at. Generally, it is true. The high deductible plan is going to be the lowest cost.
Okay. And basically, if this young, healthy woman is on a high deductible plan, her monthly expense might be lower.
Might be zero.
But if something were to happen,
yeah,
you needed to go to the ER, or she need to get surgery.
Yeah.
Because it's high deductible, she has to pay out of pocket till she hits that number.
That's right. So if your surgery is $8,000, it's still going to be capped. Maybe your high deductible is $2,000, but you're going to be paying the $2,000. Then you're going to be paying a percentage of the remaining $6,000 until you max out at what the maximum out of pocket limit is.
Got it.
And that's kind of changed. That's based on the IRS. They set those limits every year. It changes a little bit every year. So you're not unlimited, but you are going to be you could have these very lumpy bills where it is better for higher income people because they can withstand that.
Right.
If you are in the more kind of, wealth building phase, you don't want to be in a situation where you're afraid to go to the doctor because you don't want your kid is sick or something.
Right. Okay, how about the bottom two examples? Mom of two young kids, and one of the kids has special needs.
Yeah. So, what I would say, both of these sets of couples, these are situations where the benefits that they need are so expensive and so, not guaranteed to be covered. It could truly be worthwhile to look into new jobs that have these kind of employer sponsored benefits. It's increasingly becoming common that large companies will provide an advanced autism benefit. So, if you are like a mom of these kids and maybe whatever skills you have in your job, you could work in the tech industry instead of, the manufacturing industry, maybe you want to go get that tech job. Obviously that's not kind of a simple overnight answer, but I'm just kind of highlighting it. Same thing, we were talking about the fertility benefits. Even in tech, you have some companies that only cover $10,000, and then you have some that cover over $100,000. So these are things where you want to look in advance. What's interesting, the newlyweds and the starting IVF, typically with IVF, it's encouraged that, and sometimes it's only covered if you've already proved that you tried to get pregnant naturally for 6 to 12 months. So even if you think, okay, I'm going to start trying to conceive in 2024, you might not know until you start trying if you're going to need the fertility services or not.
Right. And so it might not make sense to be on the plan, especially if it's more expensive, that where your company gives you this, because maybe they don't offer it in every single plan if you're not even going to take advantage of it.
Right. Or maybe you think it's worth it to pay as backup, because sometimes you'll find out. We've seen situations where a couple starts trying. I mean, I've had this happen with a friend, and they optimize everything around the natural pregnancy. And then literally a week in, she gets an infertility diagnosis.
Right.
And then she's like, oh no, and open enrollment is over and I can't change this now.
Right.
And then the other thing is companies tend to have a lifetime max. So maybe you work for your company, but maybe you've already used up the 20K. So maybe you're like, okay, I use that up this year. We're going on my husband's plan. His plan covers this much. And, you know, you're thinking, should I get a new job? So
Yep.
yeah.
Well, so one of our attendees is saying enrollment times when I wish I could see the future. When we can't see the future, let's go ahead because you have a ton of additional slides. Do you want to cover Obamacare or go to the window?
I mean, we can do this really quickly since it sounds like not many people on the call are in this situation. I mean, I think the biggest difference, Obamacare came into law in 2014, and part of the idea is that you shouldn't be spending more than X% of your income. I think it's something like 8%. It might change a little bit every year. So what's important when you're looking at the marketplace is accurate estimate of your income, because if the insurance is expensive, you're going to get subsidies from the government. So, you know, if someone's making $65,000 in New York City, they could be getting free insurance. They could be getting over $1,500 a month in subsidies. They can qualify for silver plans with lower deductibles. So you're going to want to look at your income. And then the other thing that's super important for marketplace that's not as important on employer plans are the networks and the doctors. So you want to come up with a list of your must-see doctors, because you're going to see all these insurance companies, brands you've never heard of, and some of them are not going to be in network with your doctors. But we can speed through this since it sounds like it doesn't apply to that many people. Again, and I think we could just skip right over this. If this does apply to you, this will be in the reference materials, and this just explains how to estimate your income. So here we have kind of an acronym.
I'm so excited for this slide because we're talking about deductibles and HDHP, and I feel like I mean, I like know a lot of this stuff, but it still feels so foreign to me. So please help us understand all of these terms.
Yeah, so I think what's funny is I think you had initially highlighted a couple of things and I added a bunch more. But since there's so much on this slide, I mean, do you want to start, and maybe we have people also just chime in on the chat and say which acronym or what thing they might want me to go over, but do you want to start? I think you maybe mentioned HMO versus PPO and
yeah, I was on a call yesterday with my doctor scheduling my annual visit. And they're like, do you have PPO or HMO? It doesn't even say on my card. I have no idea. And what does that even mean? And now I'm like, should I know what this is? And I'm deciding in open enrollment, like I should know what this is so I can pick the best plan for me and my baby. What is it?
What are they? The difference? Yeah, PPO is preferred provider organization. And that at a high level, it typically just means that you have in-network and out-of-network coverage. So it means that if you go to a doctor that doesn't take your insurance, you can typically get some money back still. Now, the row above it, I put HMO and EPO on the same line. This is the reason they're on the same line. They both only have in-network coverage. So that means if you go to a doctor that's out of network, you're just cash pay with that doctor, or try not to go to those doctors. But so these are on the same line because they're both in-network. HMO, Health Maintenance Organization, EPO, Exclusive Provider Organization. The difference is whether you need a referral or not. So if you're on an HMO, you're going to have to designate a primary care physician, a PCP. And anytime you want to go to any other doctor, you have to get a referral from that primary care physician. This is, you see these plans more like Kaiser. You see them a lot more on the West Coast, although you do sometimes see them in Massachusetts. I think that's where you're based, Chrissy.
Yep.
You know, the EPOs, we see those in New York City a lot because New Yorkers don't want to get referrals. So it can be nice to be on, you know, it might be in network only, but you don't need to get permission from your doctor every time you want to go see a specialist.
Is there one that's better in your opinion? Or it depends on your situation?
Not needing a referral is more flexibility. So it's that restriction. But if your doctor, a lot of times the HMO might be more affordable. So if you don't mind, if your doctor takes Kaiser and you have a relationship with them and you don't mind getting that referral, it could be a way to save money.
Got it. Okay. So usually HMO is less flexible, but less expensive.
That's often.
Okay. PPO, more flexible, more expensive.
Often. Again, you have to run the numbers though, because the insurance companies, like sometimes they're using these more as marketing terms. So You could get a PPO on paper, but it's a really bad PPO, or it's priced really inappropriately, or it has out of network coverage, but the out of network coverage is bad and has like you're almost never going to get reimbursed.
Okay.
But yeah, at a general level, yes. The high deductible plan, the HDHP, high deductible health plan, this is kind of an extra label. So most high deductible plans, they are PPOs. They're PPO plans that are also high deductible plans. You can also have an EPO that happens to be a high deductible plan. It's purely defined by how high is the deductible, what is the max out of pocket limit, and typically there's no copays on a high deductible plan. That's the main downside. There's co-insurance. There's a percentage of the charges.
Okay. What is bronze, silver, gold, platinum?
So those are the metallic levels. They correspond to kind of actuarial language, but on a simple level, it's designed so that as a consumer, you can know that a platinum plan is better than a silver plan because it's intuitive. So the levels are platinum plans, typically 90% of the costs you incur are covered by the platinum plan. Gold is 80, silver 70, bronze 60. Catastrophic is a special plan if you are under the age of 30, and this is again a marketplace concept for Obamacare. If you're under the age of 30, you can get a really cheap health insurance plan for like $200 a month. It covers almost nothing. The only reason they'll do it is because you're under 30.
Got it. Okay. Because we're almost at time.
Yeah.
Anyone have questions in the chat? And then I want you to go over this slide because I think it helps to like visualize everything that you just described, which is comparing, you're making a trade-off decision.
Yep, that's right.
In financial planning is basically what we're doing with everything. Which loan do I pay off? Do I put more in my 401k or in my kid's 529? Same thing with health insurance. So can you take us through this example from Predictabill?
Absolutely. So this is from a tech employee, came in last week. His wife was having a baby and he was like, thinking he should do the PPO. But again, here's an example where you can see when you actually include the premiums and the money that your company puts in your HSA, you can save over $4,000 if you're willing to go on the high deductible plan. The coverage is almost identical, but the premiums are triple on the PPO. And then if you're willing to go down to the HMO where you have those referrals that you need, if your doctor's in network there, you can save even more money, an extra $3,000.
Okay. So the big takeaways I especially want to highlight, because we didn't talk about HSAs, is not every plan has an HSA benefit.
Correct.
And an HSA, a health savings account, is sort of like an investing account.
That's right.
Your company might put money into it, but that money can grow in that account over time.
That's right. And you could be on that when you're young. You could put money into it only when you're on the high deductible plan, but you can use it the rest of your life. So later you could be on a PPO and you can still use that HSA money.
Yeah. So, who's on the call? Open enrollment's tomorrow. I want to make sure she's able to ask her question. So whoever's in open enrollment, it ends tomorrow. What is top of mind for you? You have Sarah, your expert here. While you're asking that question, Stuart, I want to bring you back in.
Yes, I got him.
Okay.
Couple questions I see. Yeah.
Mandy, do you want to read through the questions or?
Sorry, Mandy, you go.
For the group?
Yeah, I can read it to you.
Okay.
So first question for life insurance is, Stuart, can you speak to level premium, term policies versus annual term policies? And if you have an opinion of what is better.
Yeah, so level term is how it sounds, that premium, your cost will stay flat for the life of the policy. Annual premium can be beneficial if you are, and Sarah used a great term, like, sort of in your earning, if your earning years or if your earnings trending up, or you can forecast that, because what an annual term will do is it'll typically start quite a bit lower than what a level term would come in, but it will step up every year. And when it does step up at a certain point, and typically within like 5 to 6 years even, it will cross what a level term would be and can be more expensive. So it's really about sort of even distribution of cost or front loading the savings, as it were, or back loading the cost. And then I saw there was another question too. I just want to jump on as well.
Yep. The other question was, how should we evaluate insurance providers? Anything beyond looking at their Moody's Fitch ratings? Are there any companies that you recommend? And how do you suggest determining how much life insurance coverage you need?
Yeah, so I think there's really not a lot. I mean, the one that isn't listed there beyond, and these are financial strength rating providers for everyone else. You know, how secure is your premium going into the company, and how secure is it, and how likely is it the money's going to come back out when you need it? AM Best is sort of the other one. I would say they're close to the gold standard in insurance, so I would make sure you're looking at those ratings as well. The other thing I would just also look at is claims payout rates. And you can look at these customer reviews. You can look at this. Some people rank them, but basically, like, how much of a pain is it going to be to get your claim paid out? Because there is a level of discretion in that, how much they want to fight you tooth and nail. So I would encourage you to look at other customers' claims experience with any provider, and then. There aren't really individual companies I'd recommend. Everyone, like I said so earlier, people are looking for risk that matches their book of business or diversifies their book of business in a given year, month, or quarter. So shopping is really the biggest priority, and then matching your results against who you can trust based on financial ratings and other customer feedback is the goal. And then how much life insurance, it really depends on the scenarios. If you mortgage, if you're covering home payments or things like that, that's very predictable, and you can sort of look at that in a really nice tail and say, okay, we need this much money to be able to support our housing costs. If it's for family or children, that can be a little bit more lumpy, or your schooling choices, your childcare choices. So it really is just a matter of locking down your expense forecast for 1, 3, 5 years, and then thinking how much you need if you weren't able to provide that income.
On that, Stuart, this might be like too simple of a question, but like, say your annual expenses are $100,000. Like, I literally just got an email right now. Get a $16 a month for a 500,000 10-year policy. Is 500,000 the annual coverage or just the one-time payment I would get?
That would be the death benefit. So that would be like the death benefit. So that's would be the
one-time payment.
One shot, yeah.
So if $100,000 a year is your expenses, like, what coverage are you, like, how do you calculate that, their coverage that you need?
Again, if you have $100,000 a year and you were, not able to provide any income, you would look at how many years of coverage you need, and then you start to look at how much insurance you can afford to buy, right? I mean, at a younger age, it's probably going to be hard to buy a policy that's going to provide, full income protection.
Lifetime,
yeah, exactly. But it's not a perfect science, but you're going to want to maybe cover, up till age 16 if you're talking about a child, things like that. Where could you expect to hand that off, and you provided a foundation.
Got it. So helpful.
Sarah, maybe you can chime in here. Laura, this is for you. She was curious about dental insurance. Her dentist is pushing a health club instead of insurance. Do we have any thoughts here for Laura?
If that's the dentist you want to go to, it could make sense. Basically, when you have major medical coverage, like the normal health insurance, you always want to take insurance. You always want to have health insurance. But when you're looking at dental or vision, you're always going to be comparing it to, what if I don't get this at all? And what would my cash pay be? So if she's saying, I love this dentist and this dentist is doing this, that might be the better answer versus if she's paying dental premiums and her dentist won't take it. The other option, of course, is to find a new dentist who does take your insurance.
Really good question.
Perfect. And then the person whose enrollment was ending tomorrow, I think this slide and understanding what Predictabill and Marble can help you guys with will help you ensure that you're selecting all the important things while still saving money. That was really what that person was caring about.
Yes. So you can find Marble, marblepay.com. predictabill.com. And remember, Predictable's for health insurance, Marbles for everything else, including health. You can aggregate everything in one place. We have some little giveaways for folks on the call from these two amazing companies. We will send this around. There's one more message. Oh, just thank you. So thank you both, Sarah and Stuart, for educating us. I learned a ton. And this is such a really important topic for our group. So the recording will be sent out in 24 hours. Thank you both and have a wonderful day, everyone.